Rohr here with the aftermarket analysis and outlook for Thursday, October 3rd, 2013. And it was a rather steady day, a little bit of excitement early on the new low the market put in, holding on, at the top of the day to the typical afternoon gains that these markets have been making on hope something good would come out of Washington, D.C., followed typically, other than Tuesday's rather sustained friendly reaction to the beginning of the U.S. government shutdown. Gap lower and then try to stabilize. This goes back, of course, to last Friday, Monday, was even going on, in the ranging activity back into last week. But so far, the shutdown has not had a huge cost, but it has left the market in a generally more bearish state. And we'll shift into taking a look at that on the intermediate term picture shortly. But for the most part, this can be fairly short and sweet because we've already covered all of the macro background and the global technical trend tendencies in this morning's equities and fixed income video, and also the foreign exchange video, including the cross rates. So for anyone who wants a lot more depth on the specific technical trend conditions of the other equities, the fixed income, or the foreign exchange, we refer you back to those videos. Today we're just going to take a look at the S&P 500 future. And it has, again, classically, after selling off, especially after Mr. Obama's little expression of resistance to changing anything on the clean continuing resolution that they have asked for on the Democratic side, especially in the Senate, in order to get the government funded again and get the various government offices and functions reopened from the closure which occurred at midnight on Tuesday morning. That, of course, the market did not take so well. Then there was discussions of calls and contact between Reed and Boehner, etc. Still didn't amount to much, but it left the door open for a bit of hopefulness. And ultimately, though, the market did finish fairly significantly lower on the day, and this leaves things fairly fraught into Friday. And the reason for that is twofold. One, for all of the bounce today, the 60-minute MACD remains right down around its lower runaway band. And if we should be lower Friday morning early, this is going to tend to signal it can feed on itself, and that's even where the RSIs are not oversold like they were into mid-morning on the sell-off today. And significantly, the 30-minute stochastic has been pushing up, but left itself at risk later on in the session on the drift lower back into the 1670 area. The preliminary signal on the upside in the hourly stochastic is also an interesting sign, but not conclusive as of yet. There's been no crossover of SSK above SSD, so a lot of things are geared up to say, look, Friday morning, if you're lower right away, things could feed on themselves on the downside. If you're steady to higher, then the market might actually rally somewhat. It has room to move back up into the 1680s, retest this failed up break from back on the push up on Tuesday, or at least, get back up into the 1680, 78 to 82 range, which is very interesting now with the extended low that the market hit. This is the low of the overall break from today at 1663.60. And that has pulled the 25% Fibonacci retracement down to about 1678. So it's going to be very interesting on the short-term picture. On the intermediate term picture, of course, the market is still looking rather tired, especially with the sell-off that the market took today. It reinforced the degree to which Tuesday's rally, which was back above 1678 to 82 and even above the 1688.20 high of the gap higher from 2 weeks ago, that was the summer's withdrawal from the Fed chairman race, followed by the euphoria over the no taper surprise from the Fed on Wednesday, this has turned into, as we've noted previous, an exhaustion gap. And the market closing back above 1688 area might have looked like it was trying to overrun that. The dilemma is, since this gap higher, the September contract expired, and on the lead contract, weekly chart, this occurred at the top of the week when September expired, and what happened was the low of the week on the opening on Monday was actually 1695 on the weekly chart. So that's the top of the old gap, and so on the weekly, the market would actually have to be above the mid 1690s on a close, preferably a weekly close, when it could then show that this current topping action, the attempted up runaway, turns into a top once the market closes back below it, as it did last week. Then, unless you're back above the mid 1690s, you can work your way lower, at least temporarily. Might be a temporary top, didn't occur at the extreme top of a hyperbolic extension out here somewhere, but in a previous range. But if you're not going to get back above mid 1690s, you can go to lower supports that, as we have articulated previous, might be into the mid 1640s to test the upbreak on the daily chart, or even swing back down for a test of the negated down break from back on the original Fed potential taper inferences from the FOMC meeting on June 19th at 1628. And of course, that's why we felt this was going to hold so well going back to the later part of August. And with the new high, it is now also a fresh. Remember, when this was the high, this was not the 25% Fibonacci retracement. It was lower. So it's the fresh upward evolution of the Fibonacci 25% retracement into that 1630 to 25 area, more or less. And so all of that speaks of the degree to which the market could hold lower. But the downward weekly MACD has recently seen daily MACD turn down as well. Weekly stochastic turn back down after a preliminary up signal. It all feels kind of heavy still in the near term, and that fits in, of course, with the macro picture of this deadlock which the Republicans have gotten themselves into on issues that Mr. Obama most certainly and his Democratic allies most certainly are just not going to cede any ground. So the attempt to adjust the Obamacare legislation in any way through the debt ceiling process or the government funding process currently on the continuing resolution is not going to work, but the Republicans are stuck in a position that they didn't have a plan for how to get out of it if the Democrats didn't capitulate. We're not blaming the Republicans for everything that might be wrong with current funding or whether or not endorsing Obamacare. It's more like it was a poor political finesse when you don't have a plan B, and they appear stuck on a certain view that is seemingly not productive right now, which is why all of this might continue in the next week, and we are thinking you could see those lower supports, which that alone, if the equities were to slide that much and be threatening to knock out a recent pullback low, that would further possibly focus the minds in Washington to coming to a compromise. And right now, whether or not anyone likes hearing it, the ball is in the Republicans' court to go along, to get along, and work on the evolution of the budgetary process later. So just to wrap up, to discuss the other markets a bit, because we're not going to cover them, they're very much the same as discussed yesterday. The DAX on the equities is still holding up the best, not really violating its 85.5 support. FTSE has slid from 6,500, yet is holding 6,400 support very nicely today. We'll have to see if that continues to hold on Friday. Similarly, the Nikkei has dropped from 14.5 back to 14,000, but with plenty of support even anywhere down into 13.6. The govies have, of course, liked the equities weakness. We have pushed up above 126 to near 127 on the December 10-year note future, but with the real resistance up into 127.5. And the long gilt is holding up nicely into and above 110.20 to 109.85. The Bund is a bit stalled, slightly above 140, but with good secondary support in the 139.60. And the FX is still the same as noted previous. The problem emanating from the U.S. means the equities weakness is not playing well for the dollar. If there's general equities weakness, dollar sometimes gets a haven bid. But with us being the problem that is driving the equities weakness, the dollar is softening below 80 even, but so far not below 79.50 on the US dollar index. And of course the other currencies are keeping a pretty good bid against the dollar, especially the pound that's pushed well above 160, and even the Australian dollar that held so well into its 92.80 to 50, actually held the top of 92.80 to 50 earlier this week and has been pushing back up around the 94 area. And that's pretty much it for now. We'll leave you with one last look at the short-term charts on the S&P 500 future, and you can just see how everything is primed to either maybe be very much more stabilized if this market's higher early on Friday, but if it's lower, it could abort the near-term friendly signal from the 60-minute stochastic and do a premature downturn in the 30-minute stochastic, reinforcing the failure to really turn up on the 30-minute MACD, and most importantly, lower early on Friday might put the 60-minute MACD below its runaway band and signal that any weakness might be able to feed on itself. And with that, have a great evening, and we'll be back to you after the close on Friday with our end of week global view. Bye for now.